Last week ended in a casual bludgeon. Friday's close saw the Dow down 2.82%, the S&P down 2.77%, and the Nasdaq down 2.55%. You had our UVXY leveraged fear index up 18% on Friday alone, more so if you include Thursday's run. And we've now erased more than half of our extensive recovery we had from the 15th of March after the Fed's meeting to March 29th when markets started losing confidence again in the Fed's trajectory and expected even more aggressive hikes. And as Jerome Powell has acknowledged a strong possibility of a half-point rate hike, markets are already starting to expect the next level on top of that. Fed fund futures traders now see a 94% likelihood of a 75 basis point hike in June. Now, if you go back to the beginning of this inflation fear, you had what getting bludgeoned the most? Obviously growth stocks, and then growth tech, and then bigger tech. Any company that's factoring in a time horizon of more than 6 months, the market started beating down as higher interest rates caused people to shorten their time horizon. Though as we get more aggressive with these hikes and the overall hike conversation, the inclination is that even on a 6-month time horizon, that's not safe either. What if these rate hikes end up landing us into a deep recession? Then it doesn't matter if your company can pass on pricing pressures to consumers or not. People are fearing a hard landing that lands everything into a recession. And let's be real, watching the Fed and the economy and the overall market's reaction to those two things over the last 12 months has been like watching a train slowly and painfully progress to a track that may eventually lead it off a cliff. And we all hope that they're going to be able to build more track or figure out how to reroute the damn train, but there's not much that we can do. We're just forced to sit in that train and say, oh, I hope that conductor knows what he's doing. But of course, rain or shine, there's always tons of opportunities to exploit. And in this video, I want to discuss 3 big setups that you're going to need to get ready for heading into this week, and some practical ideas on how you can attack them. And then we will be concluding with my breakdown on the companies that are going to be reporting this week. But first, a quick plug, just a reminder that our coupon code Never Give Up on ZipTrader U will be expiring at the end of this week. And after that, we will, on top of that, be raising our one-time fee. So if you are looking to join us for lifetime membership to our program, make sure to check out the link down below. But folks, please only join us if you're going to dedicate yourself to putting in the work. That means completing every lesson, perhaps even watching them multiple times, participating in the chat room, reading each and every single daily morning briefing that I post, doing your own due diligence on our price target list, practicing every risk management strategy and concept in the course via paper trading, which is a simulated trading platform. Many brokers have that. And otherwise doing your best to squeeze every single dollar you can out of our program. When I buy something, you better bet that I make sure that I get my money's worth out of it, and I expect the same from you. Okay, so I actually want to start with Madam Aggregator today. Last week, the last we talked about Aggregator was on Wednesday, and we were discussing the bludgeon that caused Aterian to buckle support levels from 7 to 6 to 5, and then headed deep into the 4s. The day after that, it buckled past the 450s, but as of close Friday, we held at 439, and at lows, we went as far as a tentative 415-ish support level. Now, what I said last week is if you really wanted to see this rally into the now past Thursday and Friday, you wanted at minimum to see this hold 5 and ideally 6 or 7, because that's where you have the biggest concentration of call options that were previously low probability, which meant that if they did have an increasing chance of expiring in the money, market makers would likely have to hedge their bets in order to stay neutral, which could cause a gamma squeeze, which is something that we had seen in the 2 weeks prior. But it didn't hold those support levels. In fact, you saw delta hedging become a negative for the stock instead of a positive. With Aterian crashing below support levels, you saw a huge concentration of put options at the 5, 5, 5, 6, and 650 strike prices on Thursday, which was one day prior to when those options were set to expire. A rush into previously lower probability put options at the same time where the price was crashing would almost certainly have caused market makers to start dumping shares or otherwise taking bearish bets in order to stay neutral. Just like when you have a strong concentration of call options that were previously low probability and are now expiring in the money, causing them to have to buy shares. Well, if you have the reverse on put options, all of a sudden they have to go and try to sell shares, or they have to figure out some other bearish bet to cancel out their now net bullish position. Whatever it takes to neutralize. The game is played on both sides. So I think along with that massive sell-off and the tide turning towards short sellers in this, you also had market makers acting as a headwind and a powerful one. But the reason that this is still relevant and why I'm talking about it today is because Aterian, despite all of this going against it, is still holding up fairly strongly. In fact, despite the options chain headwinds and the overall market dump on Friday, which was substantial, Aterian found a bottom Thursday and stuck to it overall on Friday. I mean, it was down like like 6% on Friday, but that's nothing for a stock like this. So to see this retaining power heading into this week suggests, hey, yes, this is an underdog. It's not as powerful as it was last weekend, but it is still in the game. Crucial levels this week for that gamma squeeze potential are now set lower because of the mid last week after sell-off. The first critical level, once again, is $5, but holding and retaking the 5 would be substantially more meaningful this week than it was last week. Last week, you had already started above the $5 region. This week, you're starting in a downtrend where you just broke and lost the $5 region. The probability of the 5s expiring in the money this week is 25%, whereas last week it was 72.82%, which means that market makers that sold these contracts have not factored in nearly enough of a likelihood that this holds above 5, and if it does, well, those options are going to need to be hedged, right? But of course, you also have those crucial concentrations at the 550s, the 650s, the 7s, and the 750s, which means blowing past those would be even juicier and a compounding benefit. I love Juicy McJuicies. Now, do I think Aterian can do it? Do I think that Aterian can regain its momentum? Well, I believe that the biggest advantage Aterian has right now is that it is going to be an underdog this week. Last week and really the week before that, it was approaching the week as a winner. Everybody was like, okay, yeah, this is a hot play. The expectations were high, the attention on it was high, and the hype on it was even higher. But those things set the bar very, very high, which means that if you don't hit that high bar, people lose faith very, very quickly. But if you're entering as an underdog, the expectations are much, much lower and the bar is set much, much lower, which means it's not only so much easier for you to meet that, especially in a stock whose float is so locked up like Aterian, but it's also true if you do see some reasonable bouncing back, all of a sudden these people that gave up hope on it are going to be like, wait a second, oh no, it's going up again. I guess this play hasn't turned into a backholder position yet. And then they go and FOMO back in. At the end of the day, these always end, and they always end by going dramatically down, so don't get me wrong. But as we approach this week, Aterian is back on the uptrend in terms of being talked about on forums like Reddit, and it's still holding generally decent search interest on Google Trends overall. We'll see if that trend continues into this week, but I'd say this is going to be one of the more intriguing setups that you're going to want to watch this week. Next, Lian. So ticker symbol Lian has a PDUFA date, aka FDA approval decision date, for their drug mavacamten in use for hypertrophic cardiomyopathy, which is scheduled to happen on April 28th, according to biopharmacatalyst.com. Now, April 28th is coincidentally 2 days before our Never Give Up coupon code on ZipTrader U expires. And while ZipTrader U isn't a biotech company and we don't have any drugs in our pipeline, we do have quite a lovely biotech section which can teach you everything you need to know about trading biotech catalysts. But shameless capitalist Charlie aside, the reason that I bring this up is because Lian is a small biotech company, and if you actually look at their pipeline, this mavacamten approval for this particular use is one of the closest opportunities this company has to actually bring something that has been long in their pipeline to the market. As far as I can tell, it's the closest one that has a chance of getting an approval, which means if you do get an approval, that could mean a dramatic reaction on the price. Now, when you actually get down into the details, it's more in its pipeline in a commercial sense. Lian is really in a partnership with an American company and will actually be focusing on Asian markets. But the thing is, if the drug gets FDA approved in the US, that's going to be a huge benchmark approval for it and sets a standard for when small cap Lian goes and tries to sell in other markets. And likewise, the anticipation of that is what has already catalyzed the mini run we've seen from 2.6 to highs at 6.24 the last month or so. Now, my thoughts on FDA approvals and how to trade them are very practical. We aren't the FDA. If you have FDA information, call me. Just kidding. But we aren't the FDA, so we can't predict whether or not a company is going to get approval. But we can look at previous trends and look at how the market reacts to upcoming approvals and make a statistically backed decision. For example, the FDA.gov website published data recently that showed that the percentage of priority and standard applications filed in financial year 2020 and approved during the first review cycle were 81% and 53%. This drug is going through the standard review process, so that means that the odds of approval are slightly better than 50-50. So that means that the opportunity isn't in holding through approval, but in playing any pre-anticipatory runs if the stock shows more proof of concept this week. Okay, moving on. So what are some practical ways to take advantage of the market's fear and the sigh of relief that comes in between fear cycles? Well, UVXY and SVXY inverse fear indices. These follow the movements of the VIX. And what I love about these is that you get the privilege of not having to be direction dependent. Everybody wants to say, oh, I know 100% that the market's going to go this way tomorrow or that way tomorrow, or that fear is going up exactly tomorrow instead of the next day, or that fear's going down 3 days from now. How can you predict that, folks? I don't know. One person from the Fed talking could completely change the outlook in a matter of seconds. But what I love about this pair is that you don't have to be direction dependent. UVXY goes up when the VIX goes up, SVXY goes up when it goes down. which means if you have both in your toolbox, you don't care about the direction. You just want volatility because that's what matters. Now, of course, the second part is, Charlie, well, great. We have two pairs here, but how do you know which one to trade? Well, a few rules of thumb. Number one, follow direction. UVXY, for example, broke into an upward direction over a red directional SMA line all day on Friday. And if you followed that direction, you would have been with the trend all day. It ended up breaking below and rejecting a downward direction later on, but it then bounced back off with another opportunity. Meanwhile, the opposite is true with SVXY. Always remember the trend is your friend. At any given point, one of these is going to be in an upward direction. The one that's in an upward direction is the one that has a trend that's more upward. You're going to get into periods where you have a little bit more sloppy price action, where it's going back and forth and it can't hold the trend. Guess what that means? Well, you don't have a clear direction. You better avoid it. Another rule of thumb is look at your RSI. If you're getting more overbought on UVXY, for example, you may be at a crucial level and point in time where inverse SVXY is getting oversold and due for a reversion to the upside. Keep in mind that only a fool thinks that indicators are absolute predictors of where a stock price is going, especially indices stock prices. In fact, indicators are really just better ways at looking at the chart. Another rule of thumb for the UVXY and SVXY pair is to think a little bit more macro. If some sort of big event is coming that has in the past historically been very, very significant for extreme movements in either UVXY or SVXY, then you better damn well have them in your toolbox ready to exploit at the next time that event happens. For example, if the Fed's going to speak in an upcoming week, or big earnings are coming out, or some big inflation reports coming out, or some other big economic report. But anyways, the next segment, and kind of building off what I just said, we do have big earnings coming out this week, which are going to be big for the overall market because you have some major companies. On Monday, the notable ones are Coca-Cola, Activision, Otis. On Tuesday, you have UPS, GE, 3M, Raytheon, JetBlue, Waste Management, Microsoft, Alphabet, Visa, GM, Enphase, Chipotle, QuantumScape, Texas Instruments, great calculators over there. Wednesday, you have Boeing, Spotify, Meta, PayPal, Ford, Qualcomm, Pinterest, Teladoc, Las Vegas Sands, Hertz, Boeing. Thursday, you have Twitter, Apple, Amazon, Roku, Intel, Robinhood, McDonald's, MasterCard, Southwest, Caterpillar. Friday, you have ExxonMobil, Chevron, and Honeywell. Now, the biggest, most market-impacting companies will be reporting Tuesday, Wednesday, and Thursday. Pay very close attention to Microsoft, Alphabet, Meta, Apple, and Amazon. Big tech just had a big loser in Netflix, although Netflix is kind of the baby. But any big surprise in some of these big names, we've seen big surprises in them before, like with Meta. Any big surprises that cause a dramatic drop could cause all of the indices to really go into a panic very, very rapidly. Versus, I would argue, if they reported something very, very good, it probably wouldn't do much to accelerate stock prices upward. If companies report very, very good earnings and future guidance and people are super bullish for the future, people nowadays are thinking, well, okay, great, but the Fed is going to be raising interest rates, so my time horizon is much shorter. So I don't really care if they're doing great. My time horizon isn't that long anymore. They need to be doing insane, and they need to be doing that like yesterday. There's also that idea that, hey, even if they're projecting positive numbers, we're worried about what? Well, that R word, the recession. What if the Fed engineers a very, very hard landing? Could we trust these guidance numbers? Who knows? So right now you're in the situation where companies that are reporting great earnings, at best, maybe they go up a little bit. But if companies report bad earnings, they get destroyed, beat down like rabid dogs or geese in geese fields. Or geese fires. It's going to be a busy, busy week, and we'll keep you updated every single morning in our daily morning briefings with setups that we see as trading opportune, as well as what's going on and you need to know about. And of course, we'll be making our nightly videos as well. That caps off today's video. I'm looking forward to spending another week with you. Make sure to hit that ravishing like button and subscribe. Don't forget about that coupon code down below that expires at the end of the week. And of course, if you are looking to join an excellent and powerful trading app, and you would like up to 6 free stocks when signing up and depositing with our link down below, well, make sure to give Moomoo a look. Anyways, folks, have a good one, and I'll see you in the next video.